Welcome. You are listening to the Financial Survival Network. You might even be watching it now as well. We've been doing a lot of video. I got to give a hat tip to Zoom. It's made the process of doing videos so much easier and so rational and quick. I mean, it's got to be fast because, we do a lot of shows here. We can't be bogged down, with 2-hour editing jobs. It's just not going to happen. Well, anyways, technology moves forward at the same time as the U.S. monetary system moves backward or in reverse. And there's so many things happening. Our good friend Craig Hempke is with us now, tfmetalsreport.com. That is a must. You got to go there, listen to Craig's podcasts and read his articles, etc. We'll tell you more about that later. I'd like to hear from you where you think this market's going. We're going to hear what Craig has to say. Craig, you totally nailed 2019 when you said 2019 is going to be just like 2009. And that insight held true almost till the end of the year. And hey, any questions or comments from you out there, what you're thinking, where your thoughts are on the precious metals markets, on Tesla, on the stock market, we'd like to hear. Just email us, kl@kerrylutz.com, kl@kerrylutz.com. So Craig, we talked with you early in 2019. You said 2019 is 2009 redux. It basically turned out to be exactly that way. Here we are in 2020. We've seen pandemics. We've seen social unrest, the likes of which we've really never seen before. And we're seeing massive money printing, the likes of which we've never seen before. I know you've got your views. You've really thought this through probably better than just about anybody out there. Where do you think this is all heading?
Well, Kerry, first of all, nice to see you. I'm not sure we're doing anybody favors by doing this on audio or on video. We've got a couple of faces made for audio, that's for sure.
Yeah, hey, got a great face for radio.
That's exactly right. And I just correct you on one thing. The 2019 forecast was that it was 2010 plus 9. Yeah. Because the year was set up to be like 2010.
Correct.
And that's remarkable how that played out. And it was, if you go back to when I first wrote that in January of 2019, that was a rather unpopular opinion because gold had been capped and it just had no interest in it and had been below 1360 for coming up on 6 years. And so to say there was going to be a breakout and the price was going to rally to 1500 last year was, I had people writing me telling me I was, just a pumper, trying to get new subscribers and stuff. But I saw in 2019 what I saw in 2010.
You made the perfect case. Yeah, you made a case for it. You didn't just pull numbers out of your butt. You made a case for exactly why it was going to take place this way.
And you and I talked about it, 4 or 5 times as we went through the year, and it all laid out. And so, of course, I could never have seen, a global pandemic and all the shutdowns and everything else coming this year. But the forecast for this year has played out as well. I thought we'd get to 1750 or 1800 in gold. We've gotten there ahead of schedule, and I don't think we're done yet. I think we're probably going maybe to 1880. I'm not sure if we might make a run intraday or intra-week to the all-time high before the summer is over. And then we'll see from there. But anyway, gold continues to go well. Silver, I've thought would get to 20 or 22 this year, and I still think that's the case. And you might recall we talked earlier this year when I first started, forecasting where this year was going to go. We talked about the mining shares and how, it was going to be a good year for the metals, but where you were really going to get some bang for your buck was some outsized gains in the mining shares. And man, boy, we've had some fun with that on my site too.
And they're still going up too. Going up.
And there's lots of reason for them to. And for anybody listening to us today, think of interest. You got to have more buyers and sellers, right, to get a share to go up, right? Because you kind of have a limited amount on a daily basis. You've got the float. You don't. So you got to have more buyers and sellers. Okay, well, how do you get more buyers? Well, you've got to have interest in owning the shares. And in the mining shares, particularly the bigger producing companies, there's not a lot of like news that happens over the course of a week or a month, right? They're just out there drilling holes in the ground and running stuff through the smelter, and doing their stuff. Where the news comes is when they report their earnings every quarter. Okay. So for the big shares, the big producers, it's usually at the end, like it's at the end of January, early February, end of April, early May. It's now coming up late. Did I say that wrong? End of January, early February, end of April, early May, end of July, early August. Make sure I get my months right. So anyway, we're coming up on that again. And the earnings reports for the big miners that are going to get brought out in the next 4 or 5 weeks are going to be fantastic.
Oh, yeah.
Be ahead of expectations, because the average cost of gold of the second quarter versus the first quarter this year is another 10% higher.
And
so
not just that, but we also have a depression in energy prices, which is one of the largest components. Add those two together, boy.
Exactly.
Supercharged earnings.
These earnings reports in a sector that has increasing earnings, are going to be increasing dividends, are going to be increasing buybacks. There's no other sector in the stock market that does that. But again, that doesn't really, you don't get news about that. You don't get a lot of earnings upgrades and all this kind of stuff during this quarterly cycle. And so what typically happens, you get this big run up and excitement around the earnings reports, which is what we had in late April and early May. Then you get this kind of trough of interest where you have more sellers than buyers during the course of a day or a week, because, well, if these stocks aren't going to move again till August, I might as well take my money and go buy Tesla for a couple of weeks. That sort of thing. So anyway, we're now starting to get that pickup again. The GDX gold mining ETF has been up 4 or 5% the last couple of weeks in a row, while the metals had only been up maybe 1%. And so we're cooking again. So anyways, long story short, anybody listening, this would be the time here in early July that you might want to position yourself for some gains over the next month or so.
Yeah, no, I couldn't agree with you more. They've got the leverage, and like you said, there's nothing glamorous, sexy about a mining operation. Like I've seen them before, like Barrick Newmont's Nevada operation. Every couple hours they blow something up, and you see some smoke come out, and they, or Barrick being the quality company that it is, they'll get a mine expropriated here or there, in where was it, Papua New Guinea or Burkina Faso or some other place like that most people can't even find on the map. But other than that, there's no real news. Oh, well, and then acquisitions, which is, that's the news, but it just, there's definitely M&A activity in the sector, but not overwhelming amount, because they got so over levered with all their acquisitions before. They're still trying to digest them. And, so we just have a very boring sector that literally just makes money.
Right.
And more of it.
And when you compare it year over year, which is how, people always trumpet their earnings, this particular quarter, the average price of gold is going to work out somewhere north of $1,700, because we spent most of the quarter between 1680 and 1780. So it's maybe 1720, something like that. But in the second quarter last year, we spent most of our time in the 14s. Okay, so you're talking a base price of your product being 25% higher, and then, like you said, the main input cost of energy has fallen dramatically by 30 or 40, 50%. And so these earnings are going to be fantastic, and they're going to be even better than what's expected. Now, that doesn't mean, you can. I just hold mine. I don't trade them. But if you are an aggressive trader, then your opportunity is to kind of buy these things, kind of in that trough of the news cycle, which was back maybe the last week of June, in preparation for the next 6 weeks as you move back toward the earnings reports, which, like I said, are going to start 4 weeks from now, 5 weeks from now. So anyway, just kind of a heads up for folks. Yeah, and again, this is going to continue to be a great trade. Doesn't mean, it's straight up. Doesn't mean there's nothing but upticks and every day is a great one. There's always going to be, give and take and more buyers than sellers and more sellers than buyers and stuff like that. But as a sector, it's a great sector to be in. And we still have not, as far as I can tell, seen what I call the rule for our friend Rick Rule, which is, he's always talked about just 1% global asset allocation to everything precious metals. Well, what if that goes to 2? And we still haven't seen that. So what if it does go to 2 or 3 or 8, like it did back in 1980? Anyway, there's still a lot of potential gains to be made.
Yeah, I totally agree with you. This could go on for several years. It might go on longer because the recession in precious metals carried on for so many years. We just made 7.5-year highs last week or the week before. So it's only started moving really the summer of 19 was really when it kind of started its move and took everybody by surprise. No one was expecting it other than you. Other than you, I always give credit, and once I heard you say it and made the case, then I was very confident that it was going to happen because it was so overwhelming. So we've got issues with Comex. Explain to us what the heck has gone on with Comex and the LBMA.
Well, how much time do we have? I'll try to make this
the short version,
as concise of a version as I can. Over the last couple of years, the bullion banks, the big banks, JP Morgan, Goldman Sachs, you name them, the ones that not only are on the hook for physical delivery and run the physical markets in London, they maintain paper trading desks in New York as well. A great, illustration of that is this guy Nowak, Michael Nowak, that I would encourage everybody to Google that name. He was the former head of JP Morgan's global commodities trade. And he had his office in New York, but he was also on the board of the LBMA, the London Bullion Marketing Association. Okay, so he is, it's kind of hand in glove. Those things go together. Okay, so these banks had been profiting handsomely for the last couple of years in what was relatively riskless trade called an exchange for physical, an EFP. And I'd been writing about this since 2017, how this was kind of an arcane little process that just written into how the the futures contracts work. But the use of this had just exploded. And over the last, in 2018 and 19 combined, there was about 15,000 metric tons of gold moved off of the Comex and settled through this EFP. It was like, I can't even remember the total of, I'm trying to remember the absolute number, 2 million contracts, whatever it is. Comex contracts, you got to keep track of it every single day because the data disappears after a week. And so if you don't do it every single day, as I've done since 2017, you don't know these numbers. And for 18 and 19, it worked out to be almost 15,000 metric tons. Okay, so you're like, well, this has got to be bogus, right? It's got to be a lot of the same gold shifting around. These banks had gotten to the point where they were doing this 10, 20,000, 25,000 contracts a day, basically buying at spot and selling it, buying at spot in London and selling a futures contract in New York, or buying in the futures and selling in London, and working the spread between spot and the front month future contract. And if it's only a couple of bucks, you think that's no big deal. But every contract is 100 ounces. So one contract, that's $200. You do 100 contracts, that's 20,000. You do 10,000 contracts, that's 2 million. 2 million bucks a day. Well, hell's bells. Now we're talking some real money, right? So we get into March, and this is the abuse, I should say, of this EFP thing is just outrageous. The first 15 days of the month of March, they settled 290,000 contracts, okay, through EFP. 290,000 contracts. It's like 900 metric tons, okay? So every time you do this, though, there's somebody on the equal side, the other side of the trade. And so these banks or whomever, and they're abusing it. Well, somebody finally shows up when the QE to infinity was announced on March the 23rd. There's this global scramble for gold. some people finally show up, whoever they were, and say, hey, I know where you can get gold. The refineries were shut down. The mints were shut down, all of this stuff. I know where you can get gold. The Comex is doing these EFP things. Let's go get some there. And there wasn't any. And basically, the Comex, in a sense, defaulted that day. Now they since have shorted up. They started this new contract that has no volume or settlement interest in it at all, called the Enhanced Delivery Contract, where they're using fractional ownership of London 400-ounce bars to settle, and nobody's buying it because everybody realizes what a sham that is. And so to prop up, I told you this could be a long answer, to prop up the legitimacy of the Comex, or to reestablish the legitimacy of the Comex, because they're just trading futures contracts. There has to be some physical delivery at that futures contract, derivative trading price. Otherwise, it's totally illegitimate, right? I mean, here's my derivative contract for 100 ounces, Kerry, and you buy it, and we determine the price is $1,200. Well, if I don't actually deliver some physical metal at $1,200, then what does this contract even mean? I mean, it's just, we might as well be trading baseball cards. So this whole process fell apart. The Comex, again, to regain legitimacy for their pricing scheme, turned themselves, or the CME turned the Comex into a physical delivery vehicle, which we may look back upon as legitimately being the beginning of the end for the pricing scheme. Because in gold, for my 10 or 11 years I've been doing this now, in the 6 months a year that they deliver, use the air quotes, metal versus the Comex contracts, they might do 4,000 contracts a month. Maybe a busy month, they might deliver 10,000 contracts a month. Well, in April, they did nearly 32,000. And then in June, the next delivery month, they just did 52,000. And that's rolling over into silver as well. That's just not the way the futures exchange was ever designed to work. But now it is. They're forcing it to work that way. And that's what's putting a lot of these banks, these bullion banks that make money in that process, are now just saying, screw it. We've got, the Department of Justice looking into manipulation of, trading and all that kind of stuff. And now they can't make money at it either. I mean, that's why Scotia Makata's getting out of the business. They're like, why the hell are we even dealing with this anymore? And so anyway, it's a real, I feel like I've given a really long answer, but I tried to keep that as short as I can.
Well, we get the idea. So basically they're actually delivering now, stand for delivery, standard deliver.
It actually appears that there's physical metal that's moving around.
Well, they were paying people off. We heard over the years, they pay them a premium not to take delivery on these contracts, right?
Yeah, there's always been speculation about that, but there was never anything you could really prove to that end. See the contract during the delivery, like right now, the July silver contract is no longer, doesn't really trade anymore. It's in its delivery phase because it's the month of July.
Right.
So anybody that was still holding a July silver contract at the end of June had to have 100% margin, totally pay for it, to rather make delivery or take delivery of that contract during the month. That's why it's called July. That's the month that the physical settlement actually goes out. Now, again, your question was, are they making deliveries? Well, in the past, it always seemed like it just kind of circle jerk of, HSBC taking delivery 1 month and JP Morgan making delivery, and then they swap the next, delivery month, just because, again, you've got to have some appearance of physical delivery on your derivative futures exchange. Otherwise, the price that you're discovering via the trading of the derivatives has no meaning.
Right.
Okay. And so they always kind of had this charade, this illusion. And really what they're swapping is warehouse receipts and, and delivery notices and warrants and stuff like that. Now you look at what has happened, the amount of gold that is posted, by the CME shown in these vaults. or you actually track the delivery notices and then the internal movements of those vaults, it actually looks like they're trying to deliver physical metal, which then opens all kinds of issues for, and makes you think, okay, God, if the metal's still that short that they're using this exchange now as a delivery vehicle because it was never intended to be. I mean, there's just all kinds of open-ended questions that for people like me that follow this stuff, and you end up kind of
scratching your head,
staring at the ceiling, thinking about it, at 2 a.m.
That's a lot of metal to be delivering 50,000+ contracts.
Yeah, what are they doing? Driving Brinks trucks around?
I thought I've seen a lot around the neighborhood lately. I didn't know what it was because they don't pick up cash anymore because everything's electronic.
It gets to this, Kerry. If anything good has come about of this specific situation related to COVID, is when the metals crashed in March. Remember that?
Yeah.
Because it was like the world figured out that everything was coming to a stop. And all of a sudden there was deflation and liquidity was evaporating and the stock market was crashing and all this kind of stuff. And so real interest rates spiked because even though, a 10-year note was yielding 1% in a deflationary environment of -3%, that's a 4% real return, right? And so real rates spiked and the metals just...
I knew that wasn't going to last. I so knew it.
And it didn't, but here's what it did for people. They saw the Comex price go to 12 at a time when they're like, wait a second, I can suddenly see the value of owning some silver. And then they go online, and they go to a dealer and they go, eBay. Wait a second, 25?
26, yeah, eBay, the spread was $10.
Says on Bloomberg, it's 12.
Yeah.
What the hell's going on here? So that was an eye-opener for a lot of people.
And gold too. Gold, the premiums are over 100.
And so some of this delivery problem that the Comex is fighting, because it's in silver too, and they never said anything about, oh yeah, silver's in such short supply because we're not flying airplanes around and all these other bogus reasons that the CME came up with for what happened in March. But silver's now going through the same thing. We had nearly, 17,000 plus deliveries standing for July. It's like 85 million ounces. In Comex silver, that's at least 4 times the historical average. Okay, so this whole delivery thing is happening in silver too. It could just as easily be, with the demand that's out there and again, the still ongoing what must be shortages because again, 20, 22, 24, the price to actually get Eagles. It could just be wholesalers, again, looking at the Comex and going, wait a second, I can buy a contract with JP Morgan on the short side, stand for delivery at $18, take delivery, ship it off to whatever refiner, and they'll buy it from me for 21.
So it's an arbitrage then.
Could be. But at the end of the day, by turning the Comex into a delivery vehicle, it really, really upsets the business model of these bullion banks and why they're in that business in the first place. And so I don't take this as Craig Hempke says that the Comex is going to default. But this really could be what we're seeing is kind of that, even the bidding, I even squirmish to say the beginning of the end because that implies some kind of timetable.
Yeah. I
really think we're working through a process now of ultimately changing the pricing scheme, getting away from this hyper leverage, of 1 ounce being levered and hypothecated 100 times or whatever. I think we're working away from that now finally, and that's good for all of us. That's what we want.
Yeah. Hey, the banks also finance all the bullion purchases by their customers. And one of their requirements in those financing deals is either that the fabricators have to lease the metal, particularly gold, or they have to buy it and hedge it. They have to be fully hedged no matter what they do. So they're creating these contracts and then they're selling them. And like you said, the purpose wasn't for delivery. It's to stop their clients from going bankrupt if there's a sudden disruption in the supply or in the price. If the price goes up $500 overnight, every single fabricator, every single jeweler, everyone in the world would be bankrupt who deals with metals as a final product. So there actually was a good purpose for this, but
Yeah.
as usual, the banks are always looking for the guaranteed return. And we
Right.
know from history, you can get it for a while, but eventually, just like mortgage-backed securities, it is going to blow up in your
Right.
face.
Right.
And that's basically what's happening now.
Right. And yeah, and again, you could make a case for the legitimacy of how they were trying to do that business, at least on the grassroots level. But again, they're coming up with reasons to use more of their services, to get their clients to use more of their services. Because who's writing those futures contracts? Who's helping them
Exactly
with
the
all
point, or the options, or whatever. It doesn't matter. They have to hedge.
exactly.
And I
Exactly.
know one bullion dealer, you and I both know him quite well. He doesn't sell an ounce of product without being fully hedged
Yeah, you
by
have
the end
to.
of the day, because you'd be
Yeah.
insane to do it
Right.
otherwise.
That's the guys that don't operate that way are just flying by the seats of their pants. And I mean, just even the last 3 or 4 years, we know companies
We've seen them.
that have
Yeah.
all
Yeah.
because they got caught, um,
Yeah.
caught.
So they got caught with their pants down.
That's
And hey, I just want to talk
right.
for COVID for 1 second. I'm just going to
Yeah.
share this screen, and I want you to take a look at it if I can get it up there. And all right, you
Yeah.
see that?
Yep. Sure do.
All right, so tell me what you think.
Well, I mean, this is the total number of deaths per day, right? Or the
Correct.
daily change.
The daily amount of deaths. So when we
Okay.
go to, just have to move it here. Yesterday, 212 deaths, peak 2701 on May 6th.
Yeah.
But they were up pretty high, 26 on April
Yeah.
21. So you see, it's kind of looking like a bell-shaped
Mhm.
curve. Maybe it's a little
Mhm.
stretched out
Mhm.
because we flattened the curve, right?
Right. Right. And I have to think about this on a kind of a big picture level for my subscribers because you mentioned these forecasts. I mean, I work uh, under that kind of model. I've got to be able to see. I've got the reason people pay me the $12 a month, the whopping
The
12
big
bucks a month.
bucks. That's why you get the big bucks,
That's
Craig.
right, baby. That's why I'm flying first class wherever I go. But I've got to be able to look over the horizon and see what I think is going to happen next. That's that you could tell that interest rates couldn't go up any further, right? That was the genesis of that forecast in 19 because they tried to raise rates, they tried to draw down the balance sheet, and
Every time.
they crushed. I mean, it wasn't going to happen. And so now we're at this point. QE to infinity has truly begun. I mean, they'll turn up the dial and they'll turn down the dial and do all these things, but there's really no other option to other than monetizing the debt going forward. They may not be calling it modern monetary theory just yet, but that's basically what we're doing.
Yeah, we
Okay.
live in a world of instant gratification.
Right.
And, normally you would have economic disruptions and then they chop off the credit cards. You wouldn't be able to get a mortgage.
Right.
I remember in the 70s when mortgage rates went way high, banks were cleaning up, but you couldn't get a mortgage. There was actually a shortage of mortgage money.
Right.
We never have encountered that ever again. And I used to think that was a good thing, but now I see it as a really negative thing because risk is not priced into rates.
Right. No, that's exactly. That's not even a determinant of the price anymore. Because the Fed has a put on everything because they can't. Well, and so unless you want total collapse and deal with the attendant consequences, then you're just going to have to deal with the Fed monetizing everything. I mean, we've gotten to that point. And then at least they admit it, right? You've seen Kerry and Powell both on 60 Minutes talking and using the word infinite. Their ability to create cash is infinite. Well, how do they do that? The Treasury sells bonds and the Fed buys them. Okay, that's how it gets done. Now the Treasury or the corporations sell bonds and the Feds buy them.
And junk bonds and stocks.
The next time the stock market goes down, the things will be amended to allow the Fed to buy stocks as well. And they look again, Kerry, unless you want everything to collapse and we take our chances, that's what they're going to do. So that's what they're going to do. Okay. And why is that? Well, because think of all the pension funds and the institutions and the hedge funds and the mutual funds and everything else that's invested in the stock market. They can't allow the stock market to go down. They can't allow everybody's retirement savings be cut in half or by 2/3 or something like that. They just can't allow it. They can't. And they can't allow a normal interest rate to be discovered because, again, by the time you looked at the risk and the actual cost of living and inflation, all that kind of stuff, if you were to buy a 10-year U.S. government note, what would you want, Kerry? 10%?
10, 12, 15.
Right.
I mean,
okay, so
it's so risky to hold it.
So exactly. And so no rational, sane person is going to accept in a 10-year note at 70 basis points. Okay.
That's
You
insane.
can't have 10-year notes at 10% because then the interest carry cost of all of the accumulated debt is just, it just explodes. And you got to print even more cash to just cover that line item on the budget.
All right. So here's a question for you.
There's
'Cause
no going back.
we know numerous states, cities, et cetera, are bankrupt. Are they going to bail them out too eventually?
There's a lot of constitutional questions about that. Can they? Because again, the official process is that the federal government would bail them out, right? By, I don't know, either assuming their debt or giving them money to a state like Illinois, right?
Monetize their bonds.
The federal government come up with money. Well, they don't, they have tax revenue and fees and stuff like that, or they borrow it. And who are they borrowing from? The Fed. Well, I don't know if constitutionally they can do that. Is there a reason though why the Fed can't do it? Why the Fed can't buy, why the state of Illinois can't issue $50 billion worth of bonds that the Fed buys directly from them?
And the city of Chicago and the city of New York. Well, I think the bailout will eventually come. I don't see any ways because to let the state of Illinois bug out, collapse,
right?
They're probably not going to do it. But
and Kerry, it gets to the other part of this question because I hear a lot of smart people talking about debt reset and debt jubilee and all this kind of things, which if you are the debtor, if I owe you $1,000 that you loaned me, and all of a sudden I get a jubilee and I don't have to pay you back, whoopee!
Yeah, hey, we're happy.
Gary?
I'm all in favor of it, but
no.
The banks are going to collapse, obviously.
No, but if you've loaned me the $1,000 and now I don't have to pay you back the $1,000, what do you think of me not paying you back $1,000?
I think I'm going to go after you with a pitchfork.
See? And that's what gets left off the equation.
Yeah, because it's my asset.
Sheet, there's a credit and a debit, right?
You're the you're the debtor. I'm the creditor.
Right.
You have a liability. Your debt is an asset to me.
Right.
And the banks and all the financial institutions in the world their net worth is composed, whatever it might be, of debt, of assets.
Right.
Loans.
Right. So who's going to go for that? Yeah, the debtors. You tell a kid who's got $200,000 in student loans that they don't have to pay it back. The kid goes, yes. You tell the bank that they're not getting their $200,000 back. The bank goes, what the?
Yeah, we're out of business. They have such slim equity margins anyway. JP Morgan Chase, it's like a net worth of $250 billion, which is nothing.
And so what I'm getting at, Kerry, is there's no way out other than just to create as much cash as needed to keep the plate spinning. And that will only really work for so long too. But for now, that's what they're going to try. Well,
we have a saying I've told you before, the US dollar is the Taj Mahal of Baltimore. And, like everybody else is, all the other currencies are even worse.
Yeah, right.
Because there's a built-in demand for dollars coming from the big short, and they did it again. They shorted the dollar in the early part of the 2000s, and that led to exacerbation of the crash of 08, 09. And they didn't learn anything. They're still borrowing in dollars
Right.
And just the fact that they borrow in dollars increases the demand for dollars and assures that that they're going to have to pay back in more expensive dollars than what they borrowed, which is the exact opposite of what's happening if you're a U.S. debtor and you get paid in dollars and you borrow in dollars. Hey, you got the best of all possible worlds.
And that's how the system is set up. And that's why they're going to try to keep it going as long as they can. I mean,
Eventually.
this isn't complicated, but to get this back to what I focus on, any thinking person can see the destruction of the currency in that regard. I mean, the more you make of any good, by very economic definition, makes that good less valuable, right?
Of course, supply demand.
I mean, that's not complicated. And so what people are seeing is the value of owning more and more gold and silver. Just not, you don't take your whole IRA and put it in it, but I mean, it's just a hedge. It's what you got to have to counter all this madness. And more people are seeing that. And then when you factor back in this pricing scheme, which is what it is. I mean, it was designed in 1974 as a way of controlling the price by increasing the supply. The amount of metal is kind of finite. Yeah, you keep mining it and stuff like that, but in a sense, it's somewhat
goes up 2% a year for gold. That's it.
But instead,
not even now.
You get the idea behind the futures contracts was to create an alternative to the actual physical thing, to get people to actually say, oh, no, I'm fine with, this synthetic gold, this pretend gold. It's like alchemy. Well, that pricing system is based on that notion. And it's then been so now hyper levered, to an extreme that eventually it's going to collapse on itself too. And so that's like the second part of the opportunity for people. One, to understand that what's going on economically, the only way there's just no turning back. Where the Fed tried to pull the wool over everybody's eyes from 13 to 18 by saying, oh yes, we're going back to normal interest rates and a normal balance sheet. Bullshit. They were never going to be able to do that. And we know that now. And they're never going to be able to stop. Remember, it was QE1 and QE2, and they had these finite, we're going to do 60 programs a month for 10 months. There's no end date now. They're not. No. And so put those two things together, that you need to have some metal, okay, because of this constant worsening debasement of whatever currency, you live with. But then furthermore, the pricing scheme makes it appear as if metal is far more abundant than it really is. Makes for a pretty good opportunity all the way from the metals down to the mining shares.
Hey, and let's not forget, so you artificially inflate the supply. You haven't really changed the demand. The demand is there. Actually, you probably increase the demand because your price is artificially lowered. So therefore, there's more demand for it. Eventually, that's a recipe because the physical supply can't increase to meet the demand. So eventually it goes exponential. We'll see how long that takes. Anyways, hey, tfmetalsreport.com. Make sure you go check that out. Subscribe to Craig's site. It's well worth your while, and it's cheap. He gets the big bucks, $12 a month, and it's well worth the $12. And I had one other question, but I don't remember, so it's unimportant. Anyways,
how do I keep this youthful appearance?
Yeah, well, you and me both. Yeah, well, it's low stress. That's the key.
We'll cover our beauty secrets in our next time.
Another time. Oh my goodness! But yeah, the web that we weave to conceal the lies that everybody knows, but nobody wants to really acknowledge. It's just shocking, the deceit that man goes through to protect the unsustainable systems that he puts in place. In any event, email us with your thoughts, kl@kerrylutz.com. The Twitter feeds at Kerry Lutz, Facebook page, Financial Survival Network, and our site, financialsurvivalnetwork.com. Make sure you go sign up for a free newsletter. Got one going out tomorrow. Craig, we will catch up with you again in a month or two. Thanks so much.
All the best, my friend.